Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO, Paul Coles.
Awesome. Very cool. Well, welcome everybody to our Market Minute. We're excited to spend the next 25, 30 minutes with you guys, catching you up on some of the current events that we feel like are relevant and important as it pertains to your retirement, and making sure that we help you keep this journey as productive and safe as possible as you guys are kind of journeying through this retirement and current economic landscape. So Scott asked me about sporting events. I'll share a cool story from the weekend as an introduction to what we're going to talk about today. This is actually me coaching a group of 9-year-old girls. My daughter Chloe is on the front row there on the bottom right. She's the curly-haired girl, Chloe, and these are all her friends. And last season, when we coached this team of wonderful girls, we had a wonderful season, nay, magical season. We played 8 games. And we lost 8 games. So I think the term I've come up with is the opposite of undefeated. Undefeated is when you win every game, right? Right. Undefeated. So we had last year what we called a defeated season. And in spite of our defeated season, these girls weren't defeated. It was kind of fun to watch how much fun they had in spite of the fact that they lost every game. They came back this year with new jerseys. This is a picture of their this year's jerseys. And a different sense of swagger and attitude. And so they came back this season, lost the first game of the season and kind of by a lot. And these girls didn't let it get them down. In fact, they came into the next game and they won it. And they were super excited that they won it. And then they won the next game and the next game and the next game and the next game. And they won the next 6 games until they got to the last game of the season, and they played the team we lost in the first game of the season, and went down 1-0 and ended up beating that team 4-1. And the last goal was from a girl who had just played fullback the entire season. She's our anchor on fullback, and she came up to me towards the end of the game and said, "Can I play offense? I really want to play offense." And just kind of on a whim, we thought, all right, you've earned your spot. Go up there and play a little offense. And someone kicked in a corner kick, and she took that ball out of the air and put it in the net to win the game 4-1. And the girls picked up this girl and carried her off the field. It was like Rudy, like Rudy. It was great. Anyway, the reason I share this fun little story, this little anecdote here, is because I think if I were watching the trends of 9 games in a row these girls had lost, and try to forecast the future trend of what was to happen, I probably would have made some bad inferences.
Yeah, you wouldn't have thought they would have gone from worst to first.
From worst to first.
Yeah.
And so it's really easy for us to observe a small sample size and draw conclusions from those small sample sizes, and then to try to say, okay, we need to act on our conclusions with these small sample sizes, in spite of the fact that maybe we need to actually have a better sample size, more observation, and more information before we make kind of definitive, conclusive decisions, actionable items. So let's flip to the next slide, Andrew. This is a chart, what JP Morgan actually publishes, that shows asset classes and performance of those asset classes every year. And we can go back in this chart to 2010 through 2022. Scott, what are some of your observations as you look at this chart?
Yeah, this is called the Callan chart, and it's a famous chart in the investment industry. But what this illustrates is asset categories can literally go from worst to first. So if you look at commodities, for example, in 2021 and thus far this year, upper right-hand corner, commodities have done really well. But if you look at 2020, commodities were right near the bottom. Same for 2019. And so there's a lot of caution there to draw too much inference from what's happening in the here and now. One might look and say, hey, commodities are up 30% year to date. I should sink a ton of money in commodities. Well, history suggests maybe that's not the best strategy. Look at the stretch, Paul, from 2012 through 2015. commodities was the worst performer for a 4-year stretch, and by a pretty big margin.
By a very wide margin. So what would you say, Scott, to somebody who would then say, okay, well, what if we just picked the very best performing asset class from 2010 through 2022 and always just chase that hot dot? Man, wouldn't we make a ton of money?
Yeah, so that would be a perfect recipe for doing the exact opposite of what you want to do. As an investor, you want to buy low and sell high. You'd be doing the exact opposite.
That's right.
You'd be buying at inflated levels and selling at deflated levels.
Yeah, and so obviously the word of the day to all of our clients is diversification. And so when we create an investment portfolio, retirement portfolio, we're extremely specific and intentional about what asset classes go into the portfolio based on a lot of observation. We're not talking about even 10 years of observation. We're talking about 50 and 60 and 70 years of observation, and understanding how things perform in different market cycles becomes a very critical component to selecting a well-diversified portfolio. Andrew, would you mind flipping to the next slide here? And while we're doing that, the danger, the fear of drawing out inferences from small sample sizes, maybe one other fun, little analogy would be, let's say, for example, we were comparing precipitation in Seattle to Salt Lake City, right? And many of our clients are here in Utah. We have some clients up there in Washington, so you guys will get a kick out of this. If I were looking at the annual precipitation on average between Seattle and Salt Lake, I think most people would make the assumption naturally that it rains more in Seattle, and you would be correct. However, if I looked at a small sample size over any given period of time, I could create a bad conclusion with that data point. So for example, if I look at historical precipitation rates up in Seattle area over the last 100 years, I could pull out the months of July and August in 2012. And in that period of time, Seattle happened to only rain 0.2 of an inch during that period of time. It was very, very low for their historical numbers. And let's say that during that summer, I happened to summer here in Salt Lake City. And during that period of time, I hit a 4th of July barbecue and it was raining on us. And a couple of weeks later, I was attending a parade and it was raining on us. And a couple of days later, I was out on the lake trying to boat and it was raining on us. And during that period of time, it actually rained nearly 10 times the amount it did in Seattle. And so every time I'm calling back home, I'm out talking to my family members in Seattle and they're saying, man, it's bone dry up here. And I'm saying, gosh, it's been 8 weeks here of just kind of hitting this rain, this precipitation. I might infer through that experience that, hey, it tends to rain more in Salt Lake than it does in Seattle. Never mind the fact that that is wildly wrong. It's actually rains on average double in Seattle what it does here in Salt Lake.
Yeah, and if we look at like a market example of that, Paul, I found this interesting. If we look at the Dow Jones Industrial Average year to date, it's down about 13%. So, certainly has had a rough year, but not, in comparison to other indices, not too bad. The NASDAQ is down about 28% year to date. So one might make the conclusion, shoot, I should be invested in the Dow over the NASDAQ just by virtue of that recent performance. If we look over the past 3 years, the Dow is up 24% today relative to what it was 3 years ago. The NASDAQ, even with the recent pullback, is up 51% relative to where it was three years ago. So again, recency bias, focusing too much on the here and now can be dangerous for investors.
That's right. So when we talk about managing retirement portfolios, and everyone on this call, they call and they want to make sure that we're watching closely what's going on in the market and how it relates to their investments. Keep in mind, your investments are allocated in an elementary conversation with these different buckets, right? Spending, protected, defensive, and growth. And I won't go into the details of our smart retirement model, but just keep in mind that there are many different components to building a distribution bucket in your retirement, right? So we understand that some of this money is money we need today, and some of this money is money we need tomorrow, and some of this money is money we'll need in 5 and 10 years. So specifically speaking of that growth component, Andrew, would you flip to the next slide? Sometimes we use the term growth in our smart retirement conversations in a more elementary form so that we can kind of teach the principle. But within the industry itself, it gets really specific. So we have these style boxes that we refer to, and there's growth, blended, and value. Now, growth in that left column refers to companies that are specifically taking their earnings and reinvesting them back into the future development of that business, where value takes its earnings and redistributes those back to the shareholders of the firm in the form of a dividend, so to speak. And then large cap on the right side, all the way to small cap, it's looking at the size of the different companies, right? So it's saying how big is the company's capital that it's working with versus small. Do you remember the breakdown?
Yeah, anything north of 10 billion would be large cap. Anything between 2 and 10 billion would be mid cap, and then small cap is anything under 2 billion.
Perfect. So specifically, what we want to talk about today is large cap growth. Okay, so that's a style box, large cap growth. And we have with us today one of the investment selection committees that we're going to be having a conversation with about this large cap growth space. And I'll turn the time over to you, Scott, to introduce our guest.
Thanks, Paul. So we have the privilege of spending a few minutes today with Mike Shepherdson. So Mike is a relationship manager at Poland Capital, and for many of our clients, Poland is going to be a very familiar name. We use Poland's focused growth strategy fairly extensively, and a lot of our clients have that strategy. We also use Poland's international strategy as well. And Poland's just a fabulous institution, been in business since 1989. They oversee about $83 billion in assets, and it's an honor to have Mike with us. But what we thought we could do is spend some time on growth specifically and get one of our investment selection committee's perspective on growth generally. So Mike, maybe what we can do, given that a lot of our clients own Poland focused growth. In fact, Paul and I do ourselves. And we've been just super pleased with it over time, but maybe give us just a quick 30-second Cliff Notes overview of the focused growth strategy.
Sure. And appreciate you all for having me today. Just to set the table, Poland Capital has been running the focused growth strategy now for 33 years. And over that 33-year period, we've delivered about 15.3% annualized by sticking to this process and philosophy, and doing so regardless of the overall macro environment. So the goal for our portfolios is to create a concentrated group of what we believe are the highest quality growth businesses in the world that in aggregate are producing earnings growth at a mid-teens rate. And over the long term, what we found is that stock price portfolio performance tends to follow that earnings growth. And so we do that with three key tenets. The first is concentration. We believe in running a best ideas portfolio and sticking and maintaining very high hurdles for the companies that are allowed in the portfolios. We also look at some of the other portfolios out there running 70, 100 stock portfolios. By introducing a 70th or 100th holding into your portfolio, it's essentially your 70th best idea, right? The hurdles for that are lower, and we look at that as introducing more risk. So what we'd rather do is own a very select few businesses and do so for the long term. And that's where number two comes into play, which is patience. We look to own these companies for 5 to 10 years on average. And if you look back over the last 33 years of this strategy, we've only owned about 130 companies. So we truly look to own these companies through the market cycle. We look for businesses that can survive and thrive regardless of the short-term environment. And then the last is quality. So going back to keeping our hurdles high, there's several metrics we look at for profitability, returns on capital, balance sheet strength, and then on top of that, we want to see growth, so revenue and margin growth. These are our 5 guardrails, and just by applying 5 guardrails to an investment universe, we eliminate about 90% of the companies out there. And frequently, if you've had a value manager on recently, you'll probably hear the term margin of safety. And typically, investors refer to margin of safety for the price with which they purchase a security. our focus on margin of safety is the competitive moat of a business and its ability to sustain that moat over the long term. And if those two are intact, the earnings growth tends to follow, and thus your total return. So just to break it down, concentrated, patience, quality, those are the things that we focus on. And I'll pause for a second and see if there's any questions on that.
Yeah, no, I think you've touched on some really important things, Mike. And, you know, I'm a basketball fan, and kind of looking back, you know, when Tim Duncan played for the San Antonio Spurs, you know, they were a very process-oriented organization.
Yes.
They had a very disciplined process. They didn't deviate from that process, and won championship after championship as a result. And I
Dating back to Robinson.
yeah, going way back. And I view Poland Capital as having that same kind of you know, process orientation where, you know, Poland's not going to get distracted by trade wars or COVID-19 or any other, you know, consideration that isn't going to be a long-term contributor to earnings growth. And so, you know, Poland's, you know, the proof's been in the pudding where Poland has done this many times over. And I think that metric, 130 stocks over the past 30 years, that's tremendous. That's indicative of very low turnover, hence lower transactional costs for clients. And it's also indicative of your methodology of finding great companies and hanging on to those for a long period of time. To keep things moving here, Mike, really quick, talk to us and maybe educate our clients about the difference between growth and value. And as you do so, I think there's maybe a bit of a misunderstanding out there that growth equals tech, and growth is more nuanced than that. So maybe talk just briefly, difference between growth and value, and how growth encompasses more than just tech.
Sure. Well, I'm going to speak in generalities for a second, but typically when investors or CNBC is referring to growth, they're looking at companies that are growing sales at a very high rate. They tend to be tech, healthcare, consumer oriented, and then they tend to trade at higher valuations, price to earnings multiples, et cetera. On the flip side, when you look at value, typically investors are looking for companies that are trading below intrinsic value. They tend to be in more cyclical industries. And what I mean by cyclical is these industries are beholden to external variables, such as the price of oil or commodity prices or interest rates in the case of banks and real estate. Companies that, to us, don't necessarily control their own destiny. And because of that, their price can fluctuate much more in the short term. And we also tend to find fewer structural tailwinds, long-term tailwinds, such as, you know, payments moving from cash and check to digital, or advertising moving from TV and newspaper to targeted ads on the internet. And then last, I think it's important to distinguish when we talk about growth between growth at any price and what we believe our portfolio reflects, which is quality growth. So if you look at CNBC, just about every day, they talk about Cathie Wood's ARC portfolios. It's a portfolio focused on innovation in the next, 20, 30 years. None of those companies are profitable. None of them can self-fund their growth. You tend to see much higher levels of leverage on those balance sheets. And today, many of them are still relatively unproven businesses. And so it's important to distinguish between those in the growth space and, again, Poland's companies, which focus on profitability and balance sheet strength and their ability to generate cash flow and reinvest in their moats, even in an environment like today or in the midst of COVID in the first half of 2020.
And we had a client question come in here, Mike, and I'll try to pose it in the framework of what you just said. He says, NASDAQ is in the bear market. The Dow is close enough to it. He says, I know in a bear market, one doesn't want to get out of the market, but is there repositioning insecurities that will occur? So the question is Poland has these 5 tenants you spoke to. that you guys use as the process we referred to, and that's what we live by. How reactionary does Poland get when things do move into these spaces where we start to really feel the pressure of a potential bear market?
Sure. To give you the short answer, we are 100% bottom up focused on the underlying businesses. So we don't try to guess, when and how much the Fed will raise rates or where the price of oil is going from here. Everything to us comes down to the business. And there's three things that we look for. One is, what is that business's value proposition? So what is it about this company that draws customers like us to their product or service above any other company out there in that industry? What makes them the leader? Number two, if the answer to that is there still a value proposition? If the answer to that is yes, we're looking for their competitive moat. Are they reinvesting in that moat and maintaining that position as the number one leader? And if the answer to that is yes, then, well, has their market opportunity changed long term? And if the answer to all those three questions is yes, and the stock price has gone down significantly, more often than not, we're adding to that company. Year to date, within the focused growth portfolio, we've only had one complete sell that was due to a change in our long-term investment thesis, and that was Starbucks. I'm happy to talk about that, or any of the names that we've added to year to date.
Well, and maybe I'll just do a follow-up point, not a question, but a point to this client. Poland is a subset of your portfolio and most of our clients in the calls portfolio. And so they're extremely focused on what they do within that subset of your portfolio. And when it comes to being specific, like specifically they're talking about, tax loss harvesting opportunities. Of course, we, your advisors, would work with you specifically on tax loss harvesting, and those don't have to be year-end activities. Those could be activities that we can actually do intra-year if there's opportunities there. So I just want to address that question for the client. Go ahead, Scott.
Yeah. Maybe changing gears a little bit here, Mike. So growth in particular has had some tough sledding for 2022. If we were to go back to that chart, you'd see the growth has struggled in particular. Maybe tell us why growth in particular has had a hard time, and then speak to what conditions will need to change to create some tailwinds for growth that maybe aren't there right now.
Sure. Well, going back to your Callan chart, you'll find that performance by any subset in the equity space tends to be cyclical. And if you look back at what happened during COVID, many of the long-term structural tailwinds that I mentioned earlier, digital payments, e-commerce, digital advertising, were accelerated. And so markets got pretty excited about the opportunity there when you could see Amazon growing e-commerce sales 20-30% year over year, when they're already lapping a pretty high comparison there. On top of that, you had fiscal and monetary stimulus, the Fed keeping interest rates around zero. And so there was a lot more risk taking, essentially. So what can happen is valuations tend to get ahead of where the long-term earnings growth justifies. And if you were to look at growth just in general, not speaking to Poland specifically, towards the end of last year, it was hard to find attractively valued opportunities because of the run that growth companies had in 2020 and 2021. And so when you moved into this year, and we saw supply chain constraints, which led to inflation, which in turn led to rising interest rates. Higher interest rates tend to be a headwind for growth equities for two reasons. One, growth equities that can't self-fund their own growth and have to go to the capital markets for funding, that gets a lot more expensive if you're getting that funding at higher rates. And number two is when active investors look for a discount rate, essentially a rate to take all of these profits that are expected in the future and bring them back to present value. Well, when rates go up, your discount rate goes up, which implies a lower present value. And so these are two things that tend to be more sentiment driven. And you hear the expression a lot today, baby out with the bathwater. And today, we have not seen anything to distinguish quality growth from low quality growth in performance. It's what people are referring to as the duration trade. And any of these longer duration equities that are expected to be profitable far out in the future are trading off significantly in favor of short-term profits, specifically energy, which seems to be the only sector of the market that is working today. Did that answer your question, Scott?
Yeah, it does. And then maybe, you know, to complete the circle, what needs to change to kind of create that tailwind again and to lead to people, you know, piling into growth? And you made a delineation there between quality growth and just, you know, growth generally. And it sounds like the market's been agnostic in terms of selling off both. But what needs to change for Poland to look and say, hey, we've got some really good tailwinds for growth again?
Sure. Typically, time is the short answer. It takes a few quarters of these businesses reporting, because when you talk about all of these headwinds, inflation, supply chain constraints, rising interest rates, now we have a war in Ukraine, no company is unimpacted by these. And so what eventually will happen is the markets will start to look at a company like Microsoft or Amazon and see that relative to the rest of the group, the rest of the opportunity set, these companies are still thriving today. It's all on a relative basis. And just to kind of take a step back, when we were in the middle of COVID, we talked about the 4 stages of a drawdown. And it's easy to play Monday morning quarterback and look back and break every crisis down into these 4 stages. In the middle of it, it's a little trickier, but I'll use COVID as an example. So stage 1 is you have the crisis move in, and whatever narrative is behind that tends to lead to fear, and fear drives correlations closer to 1. Everything goes down. So think back to February and March of 2020 as COVID was rolling in. We had no idea what was going on or how long it would last. And ultimately, everything went down. Phase 2, the market starts to digest the current environment and say, okay, well, who are the short-term winners? Where can a business outperform right now? And we saw that in the second, third, and fourth quarter of 2020, when anything work from home, tech related started to work. And that was a rally for growth. Eventually, things will get a little bit ahead of where the fundamentals justify, which leads to phase 3, and that's reversion to the mean. So if you remember the reopening trade in the first half of last year, when auto, airline, everything that had gotten beat down by COVID started to work again, and that was much more of a value rally the first 6 months of 2021. And then the last stage 4, is once things start to even out again, markets start to refocus on long-term secular winners. And we saw that when growth outperformed in the back half of 2021 again. And so if you bring those 4 stages forward to today, we had the initial drawdown, which started in February. And when you have an energy crisis and threat of a recession, really the only 2 areas to go are energy companies and the perceived safety stocks, which are utilities and staples like Coca-Cola and Procter and Gamble. Well, now on a price to earnings basis, Procter and Gamble, which is growing 5 to 7% over the next 5 years, is at a more expensive valuation than Alphabet, Facebook, which are growing at about twice the rate over the next 5 years. And we haven't even started to see any sort of reversion to the mean. So just to bring it back to your initial question, what's it going to take? It's going to take a few quarters of these companies reporting and for the market to see that ultimately, relative to all the other businesses out there, these are more well-positioned to weather the future, whether that means a recession or a recovery.
Yeah.
We have time for maybe one more question.
Yeah. So I guess in terms of opportunities that have arisen, maybe talk to us just briefly, Mike, about some stocks that you guys have maybe gotten excited about in terms of the valuations are now more attractive today than what they were 6 months ago.
Sure. We typically balance our portfolios between what we call safeties. Companies that are growing slower tend to be more resilient, defensive in their business models. So think healthcare, like United Health or Abbott Labs. We'll balance those safety companies out with higher growth companies like Amazon or Align Technology, which makes the Invisalign braces, which on the high growth side, you do tend to get a little bit more short-term volatility and higher multiples. The high growth side has been hit much harder than many of our safeties. So we're trimming companies like United Health and Abbott. We sold Starbucks earlier in the year, and we're adding to companies like Amazon, which is now the largest position in our portfolio. We've added to Autodesk and Adobe. Adobe is a near monopoly in digital marketing. And you essentially see students going from high school to college all on Adobe software. And then when they get a job at, Nike or Adidas and they're designing footwear, it's again with Adobe's software. So these are the companies that we think have long-term sustainability, and their long-term moat hasn't changed in the least. The valuation's gotten much more attractive. But again, when you look at where the future's going in terms of all those trends that I've mentioned earlier, you might have seen a bit of a pull forward in demand with COVID, but that doesn't mean that the world's not still going there.
Yeah. Well, we appreciate you, Mike, taking a minute to be with us today and speak to our clients. I think, just getting a little insight into the process and philosophy and even the thinking of how Poland Capital makes their selections is helpful for us and our clients to kind of, be able to kind of be settled down during these periods where it's easy to make an observation in the moment and kind of infer a bad conclusion about something because we're looking at something in a very short-sighted or maybe not a long enough sample size. And just maybe to kind of bring the whole conversation in full circle, this is a subset of a much larger portfolio that our clients have as we look at their retirement accounts to help them kind of build the cash flows that they need in retirement. Some of those cash flows need to be ready to go today. Some of those cash flows need to be ready to go next year, and some might need to be ready to go in 10 and 15 years. And that's where we need to follow, some of the philosophies that Poland has here. In that, I think you said the second tenet you followed is patience, right? Having this idea of patience, even in today's current market environment, is super critical. To not be emotional, to be very, logical and not reactionary, but to have a game plan and stick to that plan. So it's an all-weather approach to how we prepare people in their retirement portfolios. The other, old adage is, it's been said, if you want to go fast, go alone. If you want to go far, take a team. Poland Capital is a very valuable member of our team in connection with many other investment selection committees that we bring to the table that bring the best ideas to our clients' portfolios to help them build very strong portfolios to weather, moments like this, and are designed to be there for the next 10 and 20 and 30 years. So Mike, we appreciate your time today, and all of our clients that joined the call. We appreciate you guys jumping on. Any other questions, comments to add, Scott?
I love what you touched on there at the end, Mike, and I think it's super important. With COVID-19 for growth specifically, demand was pulled forward, but it was a function of something that was already happening. And so I think sometimes, Paul and I and our other advisors will field concerns about, the long-term nature of the economy and, some of these companies generally. And through Poland's analytical rigor and really researching these things and kicking the tires, there are some fabulous opportunities out there that our clients are invested in today. And the key thing is to remain invested in those so that over time, organically, that growth will play out. But the key is to be patient and to let those things materialize.
That's right. That's right. Well, on that note, we will wish everybody well on the call. We appreciate you guys staying with us this last 30 minutes. And until next month, be safe. Thanks, everybody.
Thanks.